In this video, we will look at 3 dividend stocks from Dividend Aristocrats ETF, ticker NOBL. History shows that this ETF tend to outperform the S&P 500, especially during the recession. So we will look at these 3 dividend stocks. We will look at some of the numbers, their dividend, their payout ratio, their profit margins, and then in the end we will look at their valuation. So let's get started. If you want to get ideas about dividend stocks, you can subscribe to the channel by pressing the subscribe button under the video. You will not miss a single new video. Okay, so we are looking at 3 dividend stocks from Dividend Aristocrats ETF, ticker NOBL. These stocks are members of the S&P 500 and managed to increase their dividend for the last 25 years. So these stocks are often called the bond proxies. These 3 dividend stocks also have a high dividend yield. The average dividend yield is 1.7% of these 3 stocks. They have low payout ratio, so the dividend seems to be stable. We will also look at their profit margins. This is something I learned from Terry Smith. Companies with high profit margins tend to do better in the inflationary environment. So we will look at their profit margins, their gross margins, and their operating margins. Also, these stocks are very rarely cheap. So we will look at their current valuation. We will use free cash flow yield as a valuation metric. We will see if they are undervalued compared to their own history. Okay, let's look at these dividend stocks. The first stock is Emerson Electric, ticker EMR. We are building a tool that will help us to analyze companies, so we will use this tool. We can see that it's from the industrial sector. Its market cap is 48 billion. We can see that it is trading at the 52 weeks low. If we look at the 5-year chart, we can see that the price is almost the same as it was before the pandemic. If we look at their debt level, we can see that they have 6.9 billion in cash, 11.5 billion in debt, so they have 4.6 billion in net debt. If we compare that to their earnings, we can see that debt not seems to be an issue. If we look at their dividend, we can see that they have dividend yield of 2.5%, payout ratio of close to 42%, which is lower than 50%, which is something I want to see in a dividend stock. The return on invested capital is close to 13%. We can see that their growth rate is close to 8 or 6% in the coming years. Their gross margins are close to 42-41%, and their operating margins are close to 16-17%. If we look at their current valuation, we are using free cash flow yield as a valuation metric. What is free cash flow yield? It is next 12-month free cash flow divided by market cap. The average was 5.6%, and right now it's close to 7.7%. The free cash flow yield is almost the same as it was during the COVID pandemic. So according to its own history, the stock seems to be undervalued. Okay, the next stock is Abbott Laboratories. Okay, we can see that it's from the healthcare sector. Its market cap is close to 193 billion. We can see that it is trading very close to 52 weeks low. If we look at their debt level, we can see that they have close to 8 billion in cash, 17 billion in debt. This includes long-term and short-term debt. So their net debt is close to 9 billion. If we compare that to earnings, we can see that debt not seems to be an issue. They have a dividend yield of 1.67%, payout ratio of less than 50, which is something I want to see in a dividend stock. They have payout ratio of close to 42%. If we look at their margins, we can see that they are close to 58-59%. Their operating margins are close to 23%. Okay, if we look at their valuation, again, we're using free cash flow yield as a valuation metric. We can see that the average free cash flow yield was close to 3.8%, while the current free cash flow yield is 4.77. So again, just like in Emerson Electric, its free cash flow yield is almost the same as it was during the COVID pandemic. So according to its own history, the stock seems to be undervalued. Okay, the next stock is Church & Dwight. Terry Smith, famous British investor that I follow, has Church & Dwight in his top 20 positions. We can see that it's from the consumer defensive sector. Its market cap is close to 23 billion. If we look at their debt level, we can see that they have 2.4 billion in net debt. This is around 3 times earnings, so debt not seems to be an issue. They have a dividend yield of close to 1%, low payout ratio of around 31%, so dividend seems to be stable. They have return on invested capital of close to 13.5%. If we look at their profit margins, we can see that they have gross margins of close to 43% and operating margins at close to 18%. Okay, now let's look at their valuation. Again, we are using free cash flow yield as a valuation metric. If we look at their average free cash flow yield for the last 3 years, we can see that it is around 4%. Right now, it is close to 4.7%. So according to these metrics, Church & Dwight seems to be undervalued. Okay, so we looked at 3 dividend stocks from Dividend Aristocrats ETF. They have relatively high dividend yield, low payout ratio, so the dividend seems to be stable. These stocks tend to do much better during the recession. Also, if you want to have a stock with even higher dividend yield, here's the video about AT&T. If you are not subscribed to the channel, you can do so by pressing the subscribe button right here. You will not miss a single new video. Thank you very much for watching till the end, and see you in the next video.